So this is the most challenging panel of the day because this comes after a full day of very interesting discussions and presentations. But I think it's one of the most important panels of the day because we've heard today from regulators, from issuers, national authorities, but we've heard that the carbon market has 150 year tradition, is innovation, but where would the market be without investors? Probably nowhere. And they are also the ones driving innovation, be it because of demands for ESG, demands for more transparency and requirements. So a lot of the demands from the carbon label and the HCT that Luca just mentioned came from demands from the investor community. So they are also a big driver of change. Now, before I start, I just wanted to briefly reflect on what has happened in the past 12 months since we last sat, not exactly in the same place, but in the same city 12 months ago. So in 12 months, we've had a political agreement reached on the directive. So after many, many months of discussions and lobbying, it looks like we're almost there, so a home run. Well done. On the European secured note, we've been talking about this for many years, but it looks like this could be one of, there could be a political will to include this in the new commission, so we'll have to see there. That's one of the items we'll be discussing in this panel. We've heard from various panelists and speakers earlier on that sustainability and green bonds are very high on the political agenda. It's a growing market. It's still in infancy stage in the covered bond world, but in the last 12 months, we've had over 10 new covered bond issues with new issuers establishing green bond standards, social bond standards, positive impact standards, and the like. So there's more to come. And finally, I have to say that I think I'm lucky that I'm still here to have a job. 12 months ago, I was sure that our QE days would be over, that the ECB was going to announce a rate hike, and that yields would be creeping up. Boy, was I wrong. So in this panel, I'd also like to touch upon, given the very low yield environment, a world where 94-95% of the iBoxx covered bond index is in negative yield. How do investors manage? How are they navigating in this difficult environment? And is there still interest in the covered bond asset class? But obviously, I'm not going to bore you much longer because you want to hear from my fellow very distinguished panelists. But I'll let them introduce themselves.
Yes, thanks a lot, Cristina. I'm Abdi Visser. I'm from the ECB. I work in the financial markets and collateral section of the markets operations area. So actually, it's an investor panel, but I'm not part of the investors team. But that team,
the largest investment in the world.
Yes, and the colleagues who are doing those purchases, some of them are also here, and they are a sister division of ours. And I think I know also quite well what they are doing. Yeah, you just wanted an introduction, eh? Yeah, so then I pass on.
My name is Mehdi Abdi. I'm a senior fixed income portfolio manager. I'm a senior fixed income portfolio manager at Actiam in the Netherlands, and we have approximately 60 billion assets under management. And I will tell you a little bit more about we consider ourselves to be a responsible investor, and I'll hope to let you know more about that in a minute.
Good afternoon, and thank you for inviting me. I'm Lucette, Yvernault, and I'm responsible for systematic investment at Fidelity International.
Hello, I'm Giovanni Inglisa. I work in the structured finance division of the European Investment Fund, mainly focusing on Southern Europe, so Italy and Greece, and we provide guarantees on tranches of ABS of SMEs, as well as covered bonds.
Okay, well, just transitioning on from the previous panel on the covered bond directive, we're almost there. But in this low rate environment, is this going to make any difference in your investment decisions? Once the covered bond directive is actually in force, will it make you as investors feel more comfortable in the asset class? Will it open up investment into new jurisdictions? We've seen that. I think there's a third Slovak bank currently roadshowing. So I don't know if Lucette, you want to give some words?
Sure. I would say it's very important, and we've just heard from Luca that the data is now more available, and obviously all these beautiful charts and statistics which have been displayed on the screen a minute ago will be available to all investors as well as myself to propose new solutions for the client. And as you mentioned, obviously having negative yield needless to say that we need to create solutions which are more designed, much more customized to the end client, because it's not easy to navigate the market, but clients have regulatory challenges while they have to invest in this market. So I would say it's a great and quite happy relief for me, having battled with the ECBC for many years now to get a more normalized framework for covered bond. But it's also probably more important at this stage in the market that we have to navigate, that we have all this data, issuer per issuer, loan per loan, on an electronic format where my team, as systematic team, can process all this data even faster, even more accurately. We need to respond as investor much more efficiently and be almost like steward of obviously ESG future of this planet. And I think also part of the upcoming request from myself as an investor is going to be the E and the S in particular component. Obviously the G will be more company broad-based, but it's definitely something that will come as an extra request again to the issuer. But I think it's what is demanded for the market, for investors, but more importantly for insurance pension plans and all our clients who, on behalf of whom we are lending the money, to be able to carry on investing in this market. So unfortunately, I think the message for me will be more data and more reliable stream of data is probably the next move for this market.
Thank you. Mehdi?
I think, first of all, the framework enhances the transparency requirements, and there are some member states still lacking a covered bond framework. So you will see that more, actually, as you mentioned, we saw some new issuance from Slovakia. And as an investor, given the low yield environment we are in, we welcome new issuers, and it's definitely, from our point of perspective, that we do look into those new regions or new issuers. And the growth in that sector, it's said that we really like that. And another thing is for us, the ESG component is very important, but I will tell you a little bit in a sec about that.
Okay. Add, once the directive is transposed and we have, the directive talks about the labels, European covered bond, European premium covered bond, I know from your side on the collateral eligibility, you've been more maybe reticent on covered bonds with extendable maturities. You consider these to be a little bit more risky. Do you think once the directive is transposed and we have these clearly identified objective triggers in national frameworks, will the ECB possibly reconsider some of their haircuts or eligibility criteria?
Yes, thank you. Yeah, we will definitely have to make some changes in our collateral framework, if only because at the moment we still refer to usage and we have some reference to certain CRR sections. So even if we would not change anything, we would have to make changes to the references. But we will take this opportunity of the new framework also to more fundamentally look a bit more at the covered bonds treatment in our collateral framework. Of course, now there will be also a definition of covered bonds. So far, we had our own definition in our guidelines. So perhaps we can switch to the European definition. Those are all kind of questions that we will be looking at in the coming period. Of course, there's still some time because also in our own collateral rules, they would only become valid from the moment that these new rules become valid. So that still takes a few years. what you asked specifically about haircuts and so on, that all needs to still be studied. I cannot say much about it, or about the treatment of conditional pass-throughs. At least it's good if on the conditional pass-throughs, if there is more harmonization on them. So that in itself is a positive effect from the directive.
Thank you. Moving on to European secured notes. We'll see whether 12 months from now, I don't think that'll come to fruition, but whether we start to see a bit more concrete steps towards this. We've had a European Commission call for advice. The European Banking Authority responded to this call of advice by publishing their reports in July 2018. We had the consultancy report assessing the cost and benefit analysis. The EBA, in its recommendations, saw that there could be a business case, sees more of a business case for SME-backed European secured notes, maybe less so for infrastructure-backed ESNs. But they also, and in terms of assessing the preferential treatment, they gave some guidelines, although they did say that in a market that isn't in existence, it's a bit difficult to give any guidance there. But maybe, Giovanni, from your side, working for the EIF, and also being an Italian, and we know that Italy is one of the jurisdictions where you have the legislation Obbligazioni Bancarie Collateralizzate, I don't know if I said this properly, pushing for ESNs. What is your view on the ESN? Do you think this could be feasible? What would you think would be necessary to see this product come into fruition? And I don't know if you have some words on what you thought about the EBA recommendations.
So, being the remit and the core raison d'etre of EIF to stimulate the access to finance for SMEs, of course, EIF is a great supporter of the European secured note, because that would help mobilize SME assets that otherwise simply sit on the balance sheet of the banks. And this is even more true for smaller institutions that could move away from a situation whereby they do maybe a cash transaction, a cash securitization every year or every 2-3 years, to a model whereby they might have a facility that they can simply tap whenever they like by issuing a European secured note. Now, clearly, this facility wouldn't have the same size of a mortgage covered bond, but it would be a very, very important funding avenue for the times when the market might be facing a crisis. Now, for sure, there are lots of things that needs to be defined in the coming weeks or months or years. It depends on how much traction the project gets. For sure, it's going to be a product that will be more complex and a bit more cumbersome to be managed compared to a mortgage covered bond, because an investor, or I would expect as an investor, for instance, to have detailed diversification and granularity criteria that typically you don't have in such a restrictive way in a mortgage covered bond, because more or less the assets is all the same. While for
so more thorough due diligence or different?
Yeah, more exactly, more thorough due diligence. You expect concentration criteria vis-a-vis given industries to be well defined in the documentation and to lead to an early amortization if the bank cannot meet them. Then, of course, you would expect, for instance, all the assets to be belonging to the very same jurisdiction, at least for the ESNs that would be structured based on an SPV, because otherwise the structure would simply become, from a true sale perspective, too difficult to be analyzed, or even too costly to set it up. It would need to be defined probably the minimum level of OC, even though, well, this is my personal view, I think it would be better to leave this to the market to define, or to the rating agencies to define, given the target rating, because I also would expect in an ESN that the OC wouldn't be covering the typical risks of a mortgage covered bond. So it would be covering the credit risk for sure, but it wouldn't probably be covering the refinancing risk as much as in a mortgage covered bond, because SMEs are have a shorter tenor, and also because most likely an ESN would feature a conditional pass-through, which is the same, for instance, the same setup that we had in the first covered bond in which we invested, which was the Shaker Bank transaction in Turkey. Then, of course, there are some headwinds. I think the LCR treatment is one of those. I think it's very difficult to argue that the ESN would be liquid. Where we could help, and this is a small commercial for EIF, is by EIF, by providing a guarantee on the ESN, it will become a claim of a multilateral development bank. So this would help vis-a-vis fulfilling all the requirements of the HQLA requirements. And then, of course, you have the elephant in the room, which is going to be the risk weight. It would need to be thoroughly thought as to whether you really need an uplift from the mortgage covered bond. Probably you need it because it's going to be a more complex instrument. But by how much, I think it has to be thoroughly thought through because it will share the very similar mechanisms of protection. So bail-in exemption, your recourse, a cover pool monitor. So there might be an increase with respect to the risk weights of the covered bond, but probably should be fairly minor. But overall, I think the product would work. I think it would offer a higher yield for the investors, not so much because of the nature of the SME assets, which are more risky, but also at the same time you have more mitigants coming from the structure, but because you would have a novel product with also conditional pass-through feature most likely, which would introduce some sort of uncertainty for the investor. So, but all in all, we're really supported.
Lucette, you were just saying how in this low yield environment, you're looking for more yielding products. Obviously, we're talking hypothetically because banks are awash with liquidity. We'll see what the ECB announces tomorrow, but don't think in 12 months' time the situation could be so much drastically different for banks who need new funding instruments. But hypothetically speaking, if this instrument were to come to fruition, is this something that you could consider, that your institution could consider, or what are the building blocks or minimum requirements, be it transparency, be it in terms of asset quality, privileged regulatory treatment that you would need in order to be attracted to this asset class?
Yeah, I will definitely think that considered a good risk-weighted asset treatment combined with good SCR treatment, that we will definitely push it into many of our solutions. I mean, there's no reason not to, especially if you have an attractive yield on the product. I think the devil is slightly in the detail. Obviously, we know that we just celebrated 250 years of covered bond, which never defaulted. The situation of SME throughout Europe is slightly different. I think there's a whole lot of banks who have sold probably book that over time will be money good at quite distressed price, and the market is quite worried. Why? Obviously, we've been challenged by the regulator to sell them now, and who are the beneficiaries. And again, coming back to one of my previous points, I think we have to be quite reasonable and a bit more engaged about what it means to invest money of our client or on behalf of our client going forward. And I don't think we can just package everything and anything, and especially repackage things that have just been transfer hand, where most of the knowledge was with the original bank. So I would like to see some of this security issued by, obviously, the regular bank in Europe. I think there's a lot of other stakeholders who have inherited big SME book, which will be very willing also to participate in this market. These are not under the same regulator, and they're not as well regimented entities. So it will be quite interesting to see how we can develop either two-tier market or how we can get enough confidence that the information we're receiving is not second-hand as opposed to the original information which was written in the SME loan itself. So I will be very happy to invest, but I want to see how the market develops, because I think there's definitely a clear differentiation in my mind into the book which is still in the hand of the original legal party and the one that have been transmitted to other entities, basically.
Mehdi, would this something that Actiam could potentially be interested in, or is this just too far away from your mandates?
At the moment, I would say, of course, we are looking at it, but at the moment it's a little bit too far.
Yeah. I see Matthew taking notes. So I see that I know Baudouin as chairman of the ESN task force, and Luca, you have your work cut out. You did good work in the Milan meeting in February, so more work to be done. But as usual, it's very interesting to talk to these guys because it's very good to talk hypothetically about a product, but if no one's going to buy it, then you won't have a market. Now, Mehdi, moving on to you, since we've heard that sustainable finance, green bond is on the agenda in Brussels and many member states. We heard from the VDP. End of August, they published their green fund brief standards. We've had a large handful of new issuers come to the market with new green or ESG, positive impact, social covered bonds. Now, you are one of the driving forces behind this market, and you have developed a very sophisticated approach. And I understand the scoring system for analyzing what is, that we talk about green, social, different shades, but you really have a scoring system analyzing the ESG investments, not necessarily just covered bonds, but across other instruments. So maybe you can talk about what you have developed and how you go about it in your process.
Yeah, of course, thank you. At Actiam, we would like to, with all our investments, contribute to the SDG goals. So we heard today the phrase green, social, sustainable a lot. But in our view, it's not only about, of course, we welcome that and we like that, but we at Actiam use a scoring or ESG scoring methodology for all our bonds, whether it's a green or not green. Everything does in the end get a green or an ESG score, and it works. I will try to briefly explain you guys how it works. We get input data from MSCI. We have at Actiam approximately 15 ESG analysts. They look at all the issuers in the market, and they finally come up with an ESG score. And as a portfolio manager, for me, it changed a lot in the last couple of years. In the beginning, when I was a portfolio manager, I was only looking at issuers. Do I like the issuer? I did a credit analysis. After that, you looked at the spread and the level where it's coming. If those two you liked and you thought you will see performance from that, then you bought it. But nowadays, also the ESG score is becoming more important. I don't have only have to outperform on the financial terms, my benchmark, but also on ESG score, which means all our portfolio holdings should in total have a higher ESG score compared with our benchmark. And all the issuers, as said, do get an ESG score. And then returning to the green bonds, in general, the green bonds do get a higher score because, of course, that's something which we want. So there is an issue.
Just green or also social?
Social, sustainable. So there is for us no distinction between just green bonds, social or sustainable. For us, we are indifferent in all those three, but they do in most of the times do get a higher score compared with the non-green issues. For me, what that meant is actually two things. First of all, when we started with this ESG methodology, is I switched from a lot of issues which I liked in the past. Is we don't buy them anymore, and the main reason is because very low ESG score. We are in discussion with those issuers, and we are always open to talk with issuers because they are curious about what's our score and what is the reason behind it.
Yeah, so if I were your issuer, I'd say, what do I need to do to improve this ESG score? And what do you usually tell?
It depends. So we make a conference call with our ESG analysts, and we tell them, listen, these are a lot of issuer score went up at Actiam because we had discussion with them, and especially on the impact reporting side, there were some issuers of green bonds, and where we had problems like, okay, what is the impact report? And we gave them advice about what they could do, and actually they implemented those feedback, and that led to a higher ESG score. And me as a portfolio manager, then I started investing in those names. So for us, we see the whole universum or the whole greenness or ESG is really important, and we switched a set from low ESG names to higher ESG names, and also opened up a lot of new issuers with high ESG score are now in my portfolio.
And are you having problems finding instruments to invest in terms of ESG? Do you think the market is large enough, or do you sometimes feel that you have more cash to invest but not enough products out there?
In the beginning, it was of course a problem. Luckily, it's not. We don't have a dedicated green bond fund, but all the universe. Of course, you had in the beginning. I'm responsible for fixed income portfolio, which means I invest a lot in covered bonds, but I do also invest in SSA space, where you see a lot of green bond issue in the last couple of years. But you also see some governments coming up with green bonds issue in the Netherlands lately came. But you see, and there is a lot of. So the market is growing. We are not there yet, but having a problem with getting the no, I don't. I wouldn't say we have a problem getting, but we just buy some names which already are in general with their process, or the company itself has a high ESG score. So,
and in terms of ongoing reporting and reporting of the analysis of the proceeds, do you feel that there's more and more being done? Or
yeah, also on that side, as I mentioned, is because we invest in green bonds, then our clients tell us, okay, it's nice, you invest in green bonds, but what is the impact? What are the results? And you see a lot of improvements on the issuer side as well on impact reporting. We want to see, and you see more and more like the quantification, what the impact is. The methodology of this calculation, it's being transparent about it is very important. And third, but not least, some issue also let the third party review those calculations and their impact report. For us as an investor, it's really important, so we can also show our clients, listen, this is the impact that we are having by investing in those green bonds.
Sure. Lucette, you mentioned earlier the E and the G. Has there been a development from Fidelity, more especially dedicated funds being created, or what's the move been there?
Yes, Fidelity is definitively leading a lot of initiative in terms of ESG and ESG as complementary fund solution, but also I think our investment process has dramatically shifted around this year, where we have introduced this common template for all the companies that we invest in, where we have to first get an ESG score from both the credit and the equity analyst jointly, and that's often something that doesn't reconcile very well in this world. So that's been quite an ongoing challenge, but I think we are proud to say that the bulk of the company we have now invested are fully rated after the summer. But also we went the extra miles because, as our panelists have just mentioned now, the problem is also the trajectory. And the trajectory is not something that Sustainalytics, MSCI, or anybody else is going to report, because obviously they report on a standalone static format as of the last financial statement or the last information that has been disseminated. So what we force as well our analysts to adopt is what we call an outlook. So it's not an ESG outlook, it's literally the direction of travel for this company. Are they reacting to any comments on how we can improve? Are they willing to engage? And the stewardship side of Fidelity has definitely grown in proportion, obviously grown in terms of how these ideas also get transposed in any portfolio, being an ESG portfolio, an E portfolio, HES portfolio, or none of the above, but just overall portfolio. And the score is being monitored throughout the Fidelity franchise going forward. So whether you're an investor who's chosen to discuss it with us in the past or not, we will engage with all these clients and report how we're doing, what is the benchmark, and how we can improve further their solution. Not necessarily in terms of return anymore, which I think is something that has been pushed far too much and has probably impacted more environmental and social decisions around the world, probably governments as well, where people have really pushed for return, but there's definitely more engagement with the client saying, even if you haven't thought about it, I mean, how comprehensive will it be that your investment portfolio, being your pension plan, your insurance plan, will be reported with a much higher score than market. And if you have to give up a little bit of performance, is it really bad? And I think this message has been extremely, extremely well received. We've done a lot of campaigning throughout the world. I was just discussing before this panel how much engagement we've done in many different countries, but the reception is very strong. So this outlook, I think, is something that will really drive people's mind, and even clients who have never thought about it are now pondering, is it worth looking for absolute return at all costs, or is it better to be a proper engaged client and investor?
Thanks for that. Very interesting. When I've been on the road, sometimes meeting some issuers understand that this is more and more on the agenda, something that they'd like to look at. But obviously, in a world where cost reduction is the name of the game, trying to convince people from the board that it really makes sense to invest in IT infrastructure, to really invest heavily in this, in a world where maybe the funding advantage is limited, is a difficult sell. But definitely, listening to you, I think issuers should engage in much more dialogue with investors to help them in their decisions. Giovanni, from your institution, are you taking a more green tint, or have you always been very green-minded?
So we rebranded ourselves as the EU Climate Bank. So ESG for sure is going to be a hot topic for the next years, and also for the next programming period, which will be the Invest EU programming period, which will replace the Juncker plan. So 2021 onwards for the following 7 years. So far, the EIB group has basically committed to stick to the so-called Paris compliant requirements, meaning that our portfolio of investment should become a Paris-compliant portfolio of investment, so not doing harm to environment, land, water, and air. The EIB group has also pledged to gradually reduce the investments in fossil fuels, and basically there will most likely be a shift from the way that we invest in the next 7 years, because the volumes will not be the focus anymore, but the themes will become the new focus of EIB and EIF. So themes such as the environment, pollution, social impact. And this is going to require a big change, a big organizational change in our institution, because just to give you an idea, for instance, as EIF, we already run a social impact program, which is a microfinance program. And under this program, we don't simply need to report volumes of SME loans, but we want to know how much this program is actually helping female entrepreneurship or self-employed. We want to see the reporting of the people, of the borrowers we help, with a breakdown between age buckets or regions, because we want to focus, for instance, in cohesion regions. So this is really a change of mindset for an institution, and will require more and more resources to be deployed in internal organization, because otherwise the effort of saying that you're investing in environmental friendly, or you're proactively doing environmental investments, will not really yield the results that it wants to give, because if you cannot monitor, if you cannot track what you're doing, the exercise is a bit useless.
And I agree. I think on the green side, it's easier to measure the impact in terms of reduction of carbon emissions, energy savings. You can maybe quantify that a bit more. But on the social aspect, it's maybe a bit more difficult to measure. And I think some of the issuers I speak to are trying to have this reflection and see what factors they can identify to prove that they are making a positive difference and that they can measure and quantify and then translate into the reporting. Now, Ad, I haven't forgotten you're here. I know you're hiding. No, I'm just kidding. Christine Lagarde, about 2 weeks ago in her hearing before Parliament, surprised everyone by saying that the ECB could be putting a green tint to its monetary policy in the future. I mean, their ECB obviously is aware of the work that the EU is undertaking, and she did say that when the EU taxonomy and green bond standards were finalized, the ECB could possibly adopt that into their monetary policy and asset purchase programs. Is there something else that you can add, or is there other areas of the ECB that are maybe green that we don't know about?
We have a very nice green grass field when you enter our building. So, but probably you saw it because you have visited us. I also noticed you didn't ask me anything about the ESN. You didn't ask me if we are already contemplating an ESN purchase program.
Are you contemplating?
Which we are not.
No. Are you going to do that in the marketable assets?
The ESNs, remains to be seen in the end what they will look like and what their characteristics are. If they fulfill our eligibility criteria, yes. It's the typical answer you could have expected.
Maybe in the next.
But let's go to the green issues. So indeed, Madame Lagarde has been quite vocal or quite interested in the topic. And we are also looking already quite a lot into this topic. I would also like to refer to a nice speech of Mr. Curé that perhaps some of you saw some time ago about climate change and monetary policy. And we had an article also in the Economic Bulletin last year on green assets in our purchase program. So we published quite a number of data and some information on it. So it's definitely something that's on our radar screen. So it's both on the corporate side and also on in the PSPP, so in the agencies, there are also quite some number of green assets that have been bought. The ECB is also a member of this central bank network on greening the financial system. I just saw on my BlackBerry that soon there's a meeting on it again where several of my colleagues will attend. I know that they are very much looking into questions like how does climate, it's especially focused on climate change, how climate change can change the, let's say, the monetary policy transmission process and what are kind of new risks and how should we look at that. So it's also a lot of economists more that looking at it. But then also the next step will be how can you translate these kind of things also and in your monetary policy implementation. So I expect that in the course of, well, it will probably be next year that more firm thoughts will come out of that and that they might also possibly be implemented in our framework. Of course, the question is, how do you do that? For instance, so I'm responsible for the collateral framework especially. What would it mean in practice? Would you give a preferential haircut to it? But then you can wonder, haircuts are there normally to cater for the liquidity risk if you end up owning the assets because the counterparty is defaulted. You have to liquidate the asset, and then you want to make sure that within the time that you liquidate it, that the price doesn't move too much against you. It's not a priori clear that green assets have better characteristics. So I would think that at least it's a bit the same story as the lady had from the EBA on the capital treatment. It's a bit the same thing. You first need to have some history and some evidence before you can give some preferential treatment. Of course, you could also think of other things like excluding perhaps very ungreen assets. That could also be, so then you give them preferential treatment in the sense that green assets get easier access as collateral. But these are all things that we will look at in the coming years. One thing that always I notice about all these discussions about green and socially responsible investment is that the focus is very much on those assets. And but of course there are the remaining, for instance, if you focus on green, the non-green assets. So if we have the feeling that climate change increases overall risks, and perhaps in the green assets you somehow address these risks, then you still could wonder, should we also not better look at the non-green assets? Have the risk still increased actually there? And then you might even have to take, instead of preferential treatment for the green assets, perhaps you should have higher haircuts for the other ones. I don't say that's necessarily the case, but at least it's something that you can think of. Because still the bulk of the assets are the ones that you're not excited about. But you can also look how have the characteristics of those changed. Yeah, I saw him already. No, why does he say that at 4 o'clock when the conference is ending? And I'm not saying that that we necessarily will do this, but it's just something that at least I notice. People get very excited about the green part. Of course, it's always nice to feel good about yourself because you do something green. So you're doing a good job. You feel happy. But of course, all the other assets, they don't disappear. And if you think that those other assets somehow have some negative aspects on them, at least it's something that you should also think about, in my opinion. Sorry for this. I don't know, in Dutch we say you put water in people. And my final thing that I also wanted to say is, that it's important that we get more definitions. So this taxonomy is very important. I read the other day an article or a research piece actually from one of your colleagues, but probably from the equity side, from Société. There was no analysis on SRI benchmarks. And at the moment, he was analyzing 50 benchmarks. So that shows that at the moment, there's still not a very harmonized definitions and so on. So that will be very important if you want to somehow incorporate these green or social aspects in your frameworks. It's very important that you have harmonized and clearly defined concepts. So all this kind of work, working on that, I think is very good and should be supported.
Thanks for all those food for thought. Lucette, you wanted to say something?
Yes, I would concur to this idea. Obviously, you will have green asset and non-green asset, and it's also the investor responsibility to steward this company into getting this non-so-called green asset to a better place, basically. So via company policy, via improving, obviously, the impact of this company on the overall environment, but also on their social policy, we can get this asset, green or non-green, to a better place, basically. So I would concur that the stewardship, obviously, for investor is no longer something that we can delay or postpone, or even something we shouldn't consider. Obviously, it's something that our CEO at Fidelity, as well as many other investors for the market, have been extremely vocal about, but it's our responsibility to improve the environment of the planet. It's not just somebody else's responsibility, and as investor, more likely than not, we can make a real difference while we help this company get to a better place, basically.
And maybe another thing is also going to be not only identifying, in terms of green assets, it's maybe easier when it comes to new originations and when you have IT systems in place or scoring systems, but when it comes to the outstanding assets on the balance sheet, maybe these haven't been identified. It doesn't necessarily mean that they're all non-green, but it will take some time for the issuers to identify those. So I guess this is all part of the work in progress that is going in the whole industry. But definitely it's work in progress, and it's through people like you, the ECB regulators, and definitely investors demanding this, that we're all going to go in the right direction. Now I'm conscious of time. I just wanted to address the current market environment with negative yields. We've had a flurry of negative yielding covered bonds, with Erste Bank issuing a 10-year negative yielding covered bond recently. We heard from issuers this morning that this wasn't by choice. They're reacting to the market. To Lucette or Mehdi, can you invest in negative yielding covered bonds? How do you go about it?
As I'm in the situation that for my funds, I can invest actually in all the fixed income sectors, for govvies, SSAs, covered bonds, and credits. We are, as you said, in a negative environment, but I have so actually I was, or was the fund brief market where we spoke about. It's really expensive if you look at it historically. But if you have the choice between bonds and fund brief, then it looks attractive. So even if it goes very lower and the spread is 30 or 40 basis points, then it looks attractive. So, and we are as institutional investors supposed to invest our funds. So I have to move my assets somewhere. And the only risk I see is with this whole program that you see more and more the search for yield is still there, especially with this current central bank policy, which means that you see more and more moving towards, if you want yield, you move lower the lower rated names and more risky names. So I think going in the future, that could or might be potentially a problem where we have to look out that we don't, you should only, as I said, always invest in names or issuers you like, and not just, okay, if there is a yield pickup, but there is one day where everything is over and we might end up in having other problems.
And are you forced to go longer out the curve?
We are not forced, but you see, of course, there are a lot of issuers go longer, or they come up with new or longer dated maturity, especially on the govie side. You see a lot of crazy maturities, and sometimes because we are benchmark huggers, then you are actually forced in a way to buy some names or some maturities which you don't like. So actually, in a way, yes.
Yeah, I will wish, but it's just a wishful thinking from Lucette, that the ECB will not announce tomorrow further QE, because to me it's a disaster for all these assets, basically, and even bigger disaster for investors who are pushed for regulatory reason in this market. But I don't think my wish will be granted tomorrow, so we just have to make do with the market we have currently.
And if it was Frank from UniCredit earlier today said we can maybe handle some QE. It just depends on the length of the QE period. But this time tomorrow, we'll know what's in store for the market. Maybe just before closing, following on from the previous panel, maybe not Christmas list, but maybe a wish list of where you'd like the market to move in the next 12 months. So starting from you, Giovanni.
I think for us it's difficult to answer a question on cash investments because we are guarantors. And also EIF and EIB are more, it's true that they are market participants, but they're also more kind of political animals. So I think what will really shape our investor appetite in the coming years will be the discussions that are currently around the negotiation of the next InvestEU plan. So it will depend on whether we will really have to move away from big volumes and move to themes. So as I said before, like environment and social, because if this was the case, then our investments in securities or covered bonds or ABS for large amounts could become a bit under threat and could have to be diminished, because we might move to a new model whereby our resources will need to be used in order to guarantee or to fund the policy objective itself. So let's assume that the policy objective is environment or social. Our funds will need to be used to fund environment or social. So we will not be able to buy a covered bond, which is basically made up of mortgages, residential mortgages, and then ask the financial intermediary to do on lending for environment or social impact. So it will pretty much depend on how the things will evolve. We trust that we will be able to carry on with the current business. But right now, we don't know how the next programming period will be.
But you'd like to be involved in the discussions shaping the market, I guess.
We are. So, of course, we like being a market participant. So that's our hope. Yeah.
Lucette?
I will say, as head of systematic investment at Fidelity, I just wish the data would be so clean. I know it's going to be a wishful thinking, but yes, in terms of obviously the granularity of mortgage pool, in terms of, as we've just discussed for now, environmental, social, and governance consideration, if we could get scales where we can rank the company on their own data, I think we would have won the game. Not because we're demanding as an investor, but because we owe it to our client to publish like all this score in terms of what their portfolio look like. So I think we unfortunately have a little bit more of a long journey in front of us for data processing and especially providing data in the same format, in the same scale, basically. Thank you. Mehdi?
One wish is that we said the growth or the expected growth in green covered bonds, which I hope in the coming years will, which we will see. Something which we didn't discuss today is actually my hope is that this whole trade war discussion or the trade war which we have, which is actually not only for covered bonds but actually for the whole economies worldwide having a problem. I would actually wish that the Twitter account of Mr. Trump is banned and that we don't that market normalization and in a market where there is no QE anymore and getting out of this negative yield environment, which is hurting not only banks but actually everyone. And it's.
Thank you. Ed?
Well, it's a bit the same what you said at the end. Of course, it would be great if we at some point can get out of the non-standard measures and world and get back to the standard world. Yeah.
I realize none of the panels before have asked the audience for any input. Does anyone have any questions or would like to raise their hand to address a point before we close? No? Well, indeed. Ah, good.
Thank you for the panel. I would like to ask if you are worried about investor outflows after a period of negative yields or returns.
I'm not particularly worried. The ECB is going to buy the rest of the market, so there's no outflow.
I'm actually not worried either, although I don't hope the ECB will buy because the liquidity is already terrible. It's getting and they have to change the rules. They have to buy more of. So there is less and less over. They will probably have to come back to the primary and buy there. So I'm at the moment not negative, but as said in my wish, I hope that the market normalizes and that we get into the positive environment.
Join in thanking our distinguished set of panelists, and then I'll give the floor to Luca.